Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I'm going to look at an interesting specialty retailer that just came up on some of my screens. Really good cash flow yield at today's prices. It's down a little bit from its all-time highs. This is a company that IPO'd in 2020, so not a ton of public history, but the history that they have is actually pretty good. They have run into a little bit of trouble recently with some slowdown in growth, some declines on the growth side, but we'll take a look if that's going to persist or if it's a good value at today's prices. The stock in question is right in front of you. It's ASO, Academy Sports and Outdoors. These guys are based in Texas. Most of their stores are in the south and southeast, although they're expanding a bit beyond that. They have about 270 stores, so plenty of growth ahead of them. Even though they've been around since 1938, they've only really started growing in the last couple of years after a private equity company acquired them and then took them public a couple of years ago. So if you bought this stock at IPO at $13, I believe, you've done pretty well because it's trading at 46.68. But I think it might still have some runway ahead of it. So let me know if you agree and disagree in the comments down below after you view this video. As always, please do your own due diligence before making any investment decisions. I am not a financial advisor, so keep that in mind as we talk through this. So I have their investor presentation up over here. They did just have their earnings as well. Like I said, comparable sales are actually down 4.5 to 7.5% year over year. So their guidance already included that. Actually, within the earnings release, they actually beat on the earnings per common share projection for the year, kind of taking their bottom line up and their top line up by about 15 cents. So if you kind of think about this company and their current price point and the 665 low end guidance, you're talking about a 6.97x multiple on earnings. That's pretty good, especially when you compare it to some of the other retailers in the same space. I think retailers in general are kind of out of the market's wheelhouse at this point, especially ones that are in the discretionary income side of things. If the economy is going to take a dump in the near term, people are not going to be buying sports gear, outdoor gear, etc. And that's kind of what we're starting to see in the guidance of some of these companies and also with how the market treats them. Let's look at the investor presentation. Really, the opportunity here would be that this is a company that already has $6.4 billion in revenue on only 270 stores, and it's only in 18 states. So the opportunity in my mind for something like this is you're getting kind of early in on something that is going to grow and potentially double in size on the revenue and store count front in the next 5 to 10 years. And that's pretty interesting. Kind of reminds me of Tractor Supply, which has been a great performer in the last decade or so. If you go back to 2014 or so, they were sitting in a similar position as Academy Sports in terms of their revenue, in terms of their EBIT margins, in terms of their free cash flow. And that company has done very well in terms of growing their revenue, growing their EBIT, maintaining their margins, and growing their dividend as well. So it'll be interesting to see if ASO compares well against that. But I think that's kind of what I'm aiming for when I look at the financials here and when I look at the thesis behind an investment like this. In general, I'm not a huge fan of retail. Just don't love it because the retail experience sucks and I try to buy things that I think are enjoyable and are going to stand the test of time. And in my mind, if I look out 10 to 20 years from now, are people going to be shopping in store in the same way that they're shopping now? And for me, I think the answer is no. I think there are certain retailers that will survive, and maybe Academy is one of those, because people still need to have an in person experience for a lot of things. I do think grocers are one of those survivors, and potentially specialty retailers that focus on things that are better bought in person. Like if I'm going to buy a kayak, I probably want to buy it in person versus buying something online and not knowing what it looks like, what it feels like to sit in it, etc. But if I'm going to buy a pair of shoes, which they also sell, I can probably buy that online after trying on a pair. If I want to buy a t-shirt, I can buy that online without a problem. And that's just me, of course. I'm not representative of everybody. I'm not an everyman by any means. But in general, I do think retail is going to struggle in the next 10 to 20 years to maintain the sort of growth it has had in the past. Outside of some of these retailers converting and having good penetration on the e-commerce side, and obviously they're focused on that. One of the nice things about ASO is that they are seeing improvements in their margins, and that's continuing on into their current year. You can kind of see that in their updated guidance. Yes, their revenue is down, but their earnings are still sort of improving forecast over forecast. And that's because they're seeing better margins across the board. One of the things that some of these retailers mentioned in a lot of their earnings calls is shrink, people stealing stuff, items disappearing, etc. And while these guys mentioned it, they seem to have a better handle on that than some other retailers. And that's not really being rewarded by the market by any means. They're also showing, hey, our e-commerce penetration is only about 10%. I think longer term, they want to take that up. And they really want to get their income margins as high as possible, obviously, because they're not really where they want them to be. This is their locations. They're kind of under-penetrated in existing markets, and they also have a lot of states they can expand to in contiguous markets. So you can see 270 stores isn't a lot. But when you think about them versus something like Dick's, it shows you the path that they can take to grow and where their opportunity lies. So Dick's, for example, probably has somewhere close to 1,000 stores and only about 2x the revenue. So the nice thing about ASO is that they generate a lot more revenue per store than some of these other players in this space, and they do it at higher margins. And yet they're not being rewarded by the market for that. So that's one thing to look at when you think about this investment. They think they have a better sweet spot than some of these other players that they compete against. They have a certain customer. A lot of them are in that 50 to plus range. Maybe some of these 80K plus households are going to be less impacted by any recession or able to handle some sort of economic difficulties. So that's also nice to see. But they do have a significant amount of people in the lower end of the scale as well. So I don't think this shows a great story if they're trying to use it to show a great story. At the end of the day, discretionary income during a recession is going to be cut, and a company like this one will suffer. It's a matter of, can they handle a year or two or three of that, or will they be killed? And what I mean by will they be killed is, will they go bankrupt? Will they have to take additional debt? Will they have to issue shares at uncomfortable prices? Or can they kind of float on through, buy back shares at depressed prices? Because if a recession does happen, no matter where you're priced, your stock will probably drop 50%. For the most part, that's kind of how it works. But if they can kind of float through that, buy back some shares at opportune prices, in the long run, they'll be winners. So NPS stuff, great. People like them. This is kind of important in my mind. You have productivity per store, and this is what I talked about before. They make $24 million per store versus some of their competitors, which are $14 million or less. That's pretty damn good. If you look at ASO, EBITDA per store, also much better than Dick's. If you look at cash flow from operation as a percentage of sales, also much better than Dick's. So that is a decent comparison because they're kind of in the same space, and they're doing a much better job than Dick's, in my mind, in their execution in a lot of ways, whether it's inventory management, whether it's getting the most out of each store, but they're not really being rewarded by that by the market. You can kind of see similar things, and then comparing to other stores, kind of I mentioned Tractor Supply, sort of in line with Tractor Supply. They're making a lot more per store than Tractor Supply. Their adjusted EBITDA per store is better than Tractor Supply, and their cash flow from operation is right around Tractor Supply. So maybe some improvement there would be good. But you can kind of see the valuations that the market is giving some of these retailers are a lot lower for Dick's and Academy, and Academy is below Dick's even, than some of these other specialty retailers. And part of that is maybe the type of client they source, the amount they'll be impacted by cuts in discretionary income, because you're less likely to get stuff from Academy than you are from Tractor Supply if your discretionary income is pressured. That's probably reality. Same with Five Below. Maybe those customers that are more subject to financial pressures are not going to go to Academy as much as they'll go to some of these other stores. But I still think it's a relatively unfair cut they're giving to their multiples compared to some of these other retailers, which also aren't that amazing. So I'm not saying ASO is an amazing business. I'm not saying retail is an amazing business, although I do kind of like ASO and what they're doing. But it's just sometimes you get a pretty low multiple for something, and the deal just looks really good. And that's where I'm coming from when it comes to ASO. And you can kind of see that they're gaining share in a lot of areas. They have a path forward. They only have 270 stores now. They plan to open their store base by as much as 50% by 2027. And you can kind of see their goals by 2027. They're aiming for 10 billion in sales. Don't know if that's going to happen. I'm certainly not assuming that. But if that does, then that's a good thing. If they hit 13.5% adjusted EBITDA margins, you're talking about 1.3 billion in EBIT. That's EBIT, not EBITDA. And maybe 55 to 60% conversions gets you to something like 700 and 750 million in cash flow against a current market cap of about 3.5 billion. That's a pretty good yield, right? And even now they're getting 400 to 500 million in cash flow, depending on the year, versus a 3.5 billion market cap. You're talking about a free cash flow yield on something like this at today's prices of 11 to 12%. That's pretty good, even if there's some risks ahead. And there's certainly some risks ahead when you talk about discretionary income being cut, etc. But at this type of valuation, it seems relatively reasonable. The nice thing about them, if you listen to some of their earnings calls, when they do open a new store, which they're going to be doing in a big way in the next couple of years, they are basically EBITDA positive and often free cash flow positive by the first year. They mentioned that in the last year they opened 9 stores and 6 of them are already generating free cash flow before the first year is done. So that's pretty solid. Their ROIC is pretty good on these new store openings. They have a lot of leeway. And when it comes to retail, in my mind, one of the best things with retail and investing in retail is investing in companies that are small and have a lot of opportunity to expand. Because that's what ASO is right now. They're a small company that has a lot of opportunities to expand simply by opening more stores. I think they can certainly get to where Dick's is when you have 270 stores currently. You expand to, 700, 800 stores in a decade or so. Your revenue could be 3 times what it is today. And the market has to respond to that if they can keep their margins where they are. And yeah, there might be some tough times ahead if discretionary incomes are pressured, but this is a company that is sort of best of breed when it comes to how they actually manage those stores, how much they're making per store, how much revenue they're making per store. And it's not really showing up in the way the market is valuing this company, because we can look at their financials, and I'm going to go to that now, and we sort of look at how this company compares to something like Dick's, and I mentioned that before. So you've got a 627 PE for the next 12 months versus Dick's being priced at 9.16. Is that fair? Maybe, but to me, ASO is probably a better operator than Dick's. They're smaller, which means they have a lot more opportunity for growth from a unit perspective, meaning they're going to open more stores. They're managing their inventories better. They're making more money per store than Dick's, and yet Dick's is getting a 30 to 40% better valuation from the market. So I'm not seeing where that discrepancy comes in. Either Dick's is way overpriced and some of these other retailers are way overpriced, or ASO is underpriced. And I'm not sure what the right answer to that question is, but it's just something to think about. Because if you look at their financials, they've been growing at a good clip. First, taking a look at their balance sheet, they have $311 million in cash, no long-term investments. Their inventories are relatively stable. If you account for openings of stores, they're actually, I think, down 5% year over year if you account for the fact that they added 5 more stores or something like that within the last 12 months. They don't have a ton of debt, so their net debt is about 280 million, which is a very good position to be in if you are expecting some troubles ahead, because they don't have a ton of debt overhang and they have some capital leases that are kind of embedded. If you look at their cash flow, it's been relatively solid and growing, and they've used that cash flow in a good way. You can kind of see that their free cash flow was 970 million in 2021. That was a bit of a push forward of demand as people went outdoors more and really bought a bunch of stuff. 590 million last year, 2 years ago rather, and then 443 million last year. So it's shrinking a little bit, but that's to be expected simply because 21 and 22 for a lot of these retailers were kind of a push forward in demand, and now we're pulling back to more normal growth or even shrinkage. But they're still producing very positive free cash flow. They're using that free cash flow to buy back shares at what I think are very reasonable valuations. They're issuing a very small dividend, but they have the opportunity to grow that dividend. And best of all, they're not taking on debt to fund growth. They can basically do that on their own because they're generating so much cash flow. They essentially say, hey, we're free cash flow positive. We're going to use that to grow our unit count. We're going to take up our dividend a little bit, and we're going to purchase back shares when the valuation deems it is reliable. It's affordable, rather. And I think it's anytime. If I was them, I would basically be buying as much shares as I can while maintaining some sort of growth path forward. So if you look at their estimates, we already kind of talked about, well, there's a bit of a challenge ahead of them. They shrunk about 5% last year. They're probably going to shrink another 2 to 3% this year. That is going to impact their bottom line as well. But at the end of the day, they're still producing free cash flow. They're expected to produce free cash flow. Their margins are relatively steady. Now, I do believe there might be some pressure on margins as some more promotional activity comes in. Pressures from competitors, et cetera, and essentially discretionary income is cut. So I don't know if this growth is all that reasonable. So in my mind, I'm going to be a lot more conservative when I do my financial assumptions, but you can kind of see what the market thinks of this company and where they think they're going to go. And a lot of this is going to be unit growth, right? They don't need to even grow same store sales that much. They can just add 5 to 10 to 15 stores a year. And if their plan is to add 120 stores next year at even by in the next 5 years rather, even at a 20 million per store average, that's 2.8, 2.4 billion in additional revenue just from store openings. If they can get reasonable margins from that, that could be a very interesting financial proposition. And we'll kind of go to the financials now, and you can kind of see where I'm coming from. So right now, this company is trading at about 46 bucks, a market cap of 3.5 billion, just shy of that, an enterprise value just shy of 5 billion. That includes those capital leases. Not a ton of debt to worry about. Good cash position, essentially a good debt position. So in essence, you're getting a 12.7% free cash flow yield. The company does pay a 36-cent dividend, so it's a very small dividend, just shy of 1%. They grew it 20% last year. I'm just assuming they're going to grow it at about 10% on a go-forward basis. But from a cash perspective, this is a company that generates 400 to 500 million in cash a year, and they're paying 27 million in dividends. So they have the ability to raise that dividend as much as they want, but I think they feel like their money is better spent on increasing their unit count, investing in the business, and buying back shares. And I totally agree with them. If I was them, I would buy back as many shares as I can if this is the yield the market is going to give it, because it's certainly not giving this yield to all other specialty retailers for whatever reason. I don't see anything super negative about why this would be the case. I think maybe the company just doesn't have the history that some of these other companies have. Maybe there's too many unknowns. Some of the recent earnings have probably spooked the investor group because their margins are shrinking a little bit. Their revenue is moving in the wrong direction. But if you look at their revenue over 2019 or 2020, it's still up, 1.5 billion into 23 and 1.4 billion into 24. So the growth has still been there. Even though it was pushed forward a little bit, the growth has really been there. And it's allowed them to really build a very good balance sheet to buy back a ton of shares, institute a dividend, be able to grow that dividend, and be priced very fairly by the market. So like I said, I don't like retail. I'm going to be very pessimistic here. The market's assuming, -2 to -2% growth next year to like 5 to 10% growth going forward. I'm saying it's going to be -3.2, the bottom line of their guidance, basically. And then I'm going to say 2 to 3 to 4 to 5% growth in the next couple of years. And this is very pessimistic. This kind of assumes probably same store sales shrinking. It assumes less unit growth than they're projecting because they're saying we're going to be at 10 billion revenue by 2027. I'm saying it's going to be at 7 billion revenue by 2028. Very pessimistic. I'm saying margins are going to stay where they are, bottom end of their guidance for this year. They're going to shrink on a go forward basis. So we're talking about 6% margins until 2028, 2027 fiscal year, basically. I'm assuming buybacks continue, using about 35% of their cash flow for buybacks. If they generate more cash flow, the buyback yield is going to be even better. That's part of the story here. If the market is pricing something at a 12 to 13% free cash flow yield, they can buy back a ton of shares every year. They can basically buy back, even with these really conservative assumptions, they're going to generate 2 billion in cash flow by 2027 in the next 5 years. I think their actual investor presentation showed something like 3 to 3.5% billion in projected free cash flow, which is their entire market cap. They could buy back so many of their shares. Just the buyback yield alone could be really good for investors. So with all this in mind, and even putting in a 15% target return because retail sucks and I don't like it, I get a fair value of 55 bucks. And I think this is very conservative. I am saying that the market's eventually going to price this closer to like a 5 to 7% free cash flow yield once they realize that this is a consistent earner. Obviously, there's some risk here with discretionary incomes being cut. If there is a recession, will the stock drop 50%? Totally. This is the type of stock that will do that. This is a 50% drop any day of the week. But I think even if that happens, I think they have pretty sizable margins for what they do compared to some of the other players in the space. They are currently underpriced in relation to some of the other players in their space, meaning you have a little bit of margin of safety because if Dick's gets a, 6 to 7% free cash flow yield multiple. Why is this getting to 12 to 13% when I think it's a better business in terms of their execution? Don't really know anything about their stores. If you do know things about their stores and the stores suck for some reason, let me know now down below. I've never actually been to any of their stores. I'm purely looking at this from a financial perspective. I think I'm being very pessimistic here. If you kind of pencil out, well, let's say they reach 10 billion in revenue by 2027. Let's say they reach 13.5% EBIT margin. Let's say even 55% cash flow conversion, which is kind of lower than what they are, and even give them an 8% free cash flow yield at that point. This is a $9.2 billion company in 2027, which is, a pretty big return, 167% return. If that were to happen, if they reach those probably optimistic goals that they've set, I think this is potentially a company that once the market realizes what their true value is, once they prove that they can do what I'm showing here, this is a multiple of the current price type of company. And I very much like it at this price. What you're going to get is you're going to get a company that is very, very impacted by economic pressure. If there is a recession, this is going to tank and tank hard. But as long as they can maintain their solid balance sheet and keep some sort of free cash flow generative power during that period, they can potentially buy back shares during that period. They do not have a big debt overhang, which is going to be a problem. I think their first debt isn't due until 2027 or 2028. And they could just pay it off probably this year with the free cash flow they'll generate in this year's business. They can buy back more shares because you should be doing that at this free cash flow yield. And if the stock drops even more, they can continue doing that. They will probably increase their dividend. So you're only getting a 0.7% dividend, but you can potentially grow this at 20% without a problem, which yield on cash by 2027, you're going to be making 1.6. But this isn't really a dividend play for now. It's eventually going to be. I'm talking, down the line. Can I see this company being like a Tractor Supply today? And that is a $22 billion market cap company, getting 14 billion in annual revenue, probably getting 700 to 800 million in free cash flow. Can that be the blueprint for what ASO is going to become? I would say yes, and that would be my thesis. I would want this to follow that path. Unit expansion, maintaining margins, starting to grow and grow and grow in their dividend. In 2014, Tractor Supply was paying like a 60-cent dividend. Now it's paying a $4 dividend. It was a $60 stock. I'm kind of making these numbers out of thin air, so please double check that. Now it's a $200 stock. So I see the path forward for this company to be like that company and generate 15% plus returns if they can maintain what they're doing, and maybe even more if they can exceed what I'm showing here. And I think the chances of them exceeding, if you ignore the chances of a recession, are pretty good. And that's why I'm kind of liking the stock, even though I don't generally like retail. I could even pencil in a 20% return or an 18% return and still find that today's valuation is pretty reasonable. So for me, I think I might buy a couple of shares here, but I do feel like this is a company that could easily keep falling. This is, retail, discretionary retail is out of favor right now. So I'm not going to buy a full position. I'm just going to start building a small position and see where it goes from here. This would be something that I would hold for a while. Again, I don't love retail, so I don't generally get into it. But when you see something that's got basically a 13% free cash flow yield, which means to me that if they wanted to stop growing today and kind of slow down growth, they could pay me a 6% dividend and still probably grow their revenue a little bit by opening up more stores because they would still have free cash flow to drive that forward. Don't want them to do that. I would want them to buy back as many shares as they can, lower the share count. So each of one of my shares as an owner would be worth a lot more because that buyback yield is going to be worth a lot. If the market continues valuing them at a 12% yield, you're getting a 4.8% annual buyback yield just from a 35% buyback windows from 700 million in shares. Because if you think about that's buying back 10 to 15% of their company. Every 340 million that they buy back today buys back 10% of the company, and they could do that every year. And that's pretty good. And if they can improve margins, if they can hit those margin targets that are more in that 7 to 8% range in the long run, they've obviously done that in the past couple of years, but that was kind of an aberration in my mind. It's not going to repeat. But as long as they keep their margins in that mid to high single digits, as long as they can keep adding stores, self-funding because they can do that, they don't have to take on debt at high interest rates, which some companies have to do. This should be an interesting investment to say the least. So to me, I am interested in ASO. I'm going to pick up some shares. As always, guys, I am doing this for my own entertainment, not a financial advisor. Please do your own due diligence before making any investment decisions. And let me know what you think about ASO. If you've heard about it, if you like it, if you like the stores, like, subscribe, all of that good stuff. Thanks for coming. Hope you enjoyed the video. Let me know if you have any specific companies you'd like me to review. But otherwise, I will talk to you later and have a good rest of your week.